Breaking news in the BNN Bloomberg newsroom. The Bank of Canada issuing its trend-setting rate decision as expected, delivering increasing interest rates for the 8th consecutive month by 0.25%. This is exactly what the market was looking for. You can see that the loonie is flat right now, taking rates to 4.5%, the highest that we have seen since the financial crisis in this country, in a bid to quell inflation, which has come down, but is still well above where the Bank of Canada would like to see interest rates. In addition to the Bank of Canada making its decision to increase interest rates by 25 basis points, again, taking the rate to 4.5%, they have slightly, it looks like, changed the language within their statement. Previously, the last paragraph said that the Governing Council will be considering whether policy interest rates need to rise further. And if I just get down to the last paragraph here, the Governing Council decided to increase by 25 basis points. And it looks like they are signaling that they expect to hold the policy rate at its current level while assessing the impact of the cumulative increase in interest rates that we have seen. So the breaking news right now, and there's a lot more to come because they also have the monetary policy report, is as expected, they've increased interest rates by 25 basis points, taking the rate to 4.5%. But they have changed the language, signaling that they are on pause right now. And that was a little bit of a question mark going into the decision. If today they move, what do they do in March? So again, to reiterate, they are saying they expect to hold the policy rate at its current levels. That's what we have right now. We're going to bring in their economic growth projections because, again, we have that monetary policy report. We're also going to hear from the Bank of Canada today. Their press conference gets underway at 11 a.m. Eastern time. There will be question and answer, and we'll be taking that live. So a full 2 hours of Bank of Canada coverage, and I'm not doing it on my own. We've assembled a crack team to go through what this means for your portfolio and for your money. We've got Andrew McCreath of ForgeFirst, we've got Earl Davis of BMO, and we've got Jim Thorne of Wellington-Altus Private Wealth. Gentlemen, thank you so much for being with us. There's going to be a lot to unpack, but Andrew, I'll start with you. High-level takeaway, delivering on expectations and changing the language about where rates go from here.
Yes, Amber, you've been showing viewers how the Canadian dollar has weakened since the news came out, and it's because they effectively said, we're going on pause. But, you know, the fact that they've gone on pause, I'm sure is not a big surprise to any of the folks sitting around your desk right now, because we have seen the biggest rate of change of interest rates during the last 40 years, let alone longer, and it takes 6 to 12 months for that to impact the economy. And so the Fed, like the Fed will do next week, I should say, the Bank of Canada is going on pause because, to be honest, the storm in the housing market is only going to kick into gear during the second half of 2023. So it's logical what they've done. So
it's interesting that you say it's logical that they go on pause, because some might argue that the fight on inflation is far from won. Maybe one Earl Davis might argue that. What do you think?
Yeah, I agree. It's far from one. Our last inflation print was 6.3%. So the question is, how low does it go before it plateaus? And you know what? They said we're on pause. They didn't say this is terminal rates. So I think we have to remember that. It just points to pure data dependency from here on in.
Does it also show, Jim, perhaps a sensitivity to some of the softening that we have seen? I think about the Bank of Canada's own business outlook survey and the pain that businesses were pretty explicit about that they are feeling from higher rates. Do you think that's filtering into some of the thinking here?
Yes, I think the Bank of Canada and the Fed understand the fact that the generational increase in interest rates have yet to kick in, and yet we're seeing a rapid decline in economic growth and prices. Think about this. The Bank of Canada raised 25 basis points, and the Ivy PMI is at 33, which is the lowest except for March 2000. So think about, wages are declining, average hourly earnings are declining. Everything underneath the surface, if you look at the month-on-month data, suggests a rapid decline in prices and economic growth, and yet a lot of people still anchor off of the year-over-year data, which is very, very troublesome.
A rapid decline in prices.
Well, I think we got a real tag team here.
Yeah.
Earl and I against Jim. You want to go on that, and I'll
Let's
go
go
on
ahead,
that.
Ted.
Yeah, you know what's interesting? I don't think it's as rapid as the Bank of Canada thinks. I'm just reading their statement now, and they say CPI inflation is projected to fall to around 3% in the middle of 2023. I think what that does, it gives you the window of where the pause could end possibly. So we have a target now. If CPI is not at 3% by May, June, the possibility of increasing is further enhanced. So I think there's an important part in what they put out in today's NPR.
To Earl's comment, maybe we could look at that graph that shows Canadian CPI versus core CPI.
Okay.
And yes, headline CPI is going down. It's going to go down a lot more given what's going on with energy prices. But the core CPI has not gone down at all. And so when one looks at the graph that is on the screen right now, the blue line is headline CPI. But the line below it, notice how it's flatlined on the far right-hand side of the graph. You know, somewhat analogous to what you hear Powell talk about in the States. They care about core services excluding rent. Inflation in the States. And that actually ticked up last month. Look at Walmart. Walmart increased wages 17%. Yesterday. We're going to see a lot more of that. I think a Canadian Revenue Agency workers want 30 over 3 years.
Fine. What is Walmart going to do when they see an economic slowdown? Are they going to increase prices? No, they're probably going to look to lower them. Well, and that's going to have, fine, it might hurt their margins, I'll agree with that, but most companies are going to respond by cutting prices.
I think the key thing in what you just said is yes, that's what they'll do. But the question is, when will that show up? When will we have that recession? And I think the key word right now for both Canada and U.S. is resiliency.
Yep.
Growth is a lot higher than the forecast that the Bank of Canada and the Fed had previously. So I think that's a key component.
So whoa. PMI at 33 is strong growth. The services PMI in the United States and the manufacturing PMI under 50 is strong. You've had the most rapid decline of prices paid in the history of the data set. And you guys are saying you don't see a slowdown.
You're not talking services.
Exactly.
No, but hold on. But services has
You
always run higher. Services since 1945 has run at a 3.8% clip. Services PMI has, our prices and inflation has always run higher than goods. It is a specious argument to basically sit there and move the goalposts again.
Incorrect.
This is a change of price level, not a change in relative price level. So we can go on for years finding certain areas in the economy because of the structural changes that are going on where you're going to see inflation and there's going to be deflation in other words. So here's my last
what you said.
But let me just sit there. First off, you can't use seasonally adjusted data. First off, okay? Because it's not seasonally adjusted data anymore, it's COVID adjusted data. And there's going to be massive revisions coming. This year, we're going to have massive revisions in the United States on the labor data, okay? 2, if you take annualized, non-seasonally adjusted CPI, we're running at 0.2%. That is, the target is 2%. Third, there is a massive fight on average inflation targeting, basically saying that we have been below the 2% target for generations. We need a short period above 2%. If you take into consideration all of the inflation that has happened during COVID, we still haven't reached our 2% target.
Okay, last word on this, and then we're going to move on. Go.
History rhymes, it doesn't repeat. And so I don't care about the 40s, the 50s, the 60s. It's a different cycle. It's a different world today. And when one looks at what's going on in the labor markets, there is a structural mismatch between the supply and demand of labor. You look at the SEP, sort of the dot plot from the Fed, they're willing to accept a 100 basis point increase in the rate of unemployment by the end of 23, up to 4.6, I think it is. And they still believe the terminal rate stays higher for longer with a 5 handle on it. Now, the market's pricing it differently right now. So history history rhymes, it doesn't repeat. Point number 2, because of that structural mismatch in labor and the fact that 80% of the population, the bottom 80% of the population has been drilled against the wall because of inflation, they want more money. Walmart hiking rates, labor rates, 17%. As I said to Amber just at the end earlier, the Canadian Revenue Agency workers want a 30% raise over 3 years. I mean, bottom line is, I think wage hikes are going to stay sticky. And what do you think drives service pricing? It's wages.
Okay.
So, of course, goods are going to go negative year over year, but services is going to be the stickier area.
All right, we're going to have to take a quick break. Just to recap, the Bank of Canada making its trend-setting interest rate decision, increasing by 25 basis points, taking rates to the highest level that we have seen since the financial crisis, but also signaling that now they are on pause, while also suggesting that they could increase rates yet again. They are changing the language that they're on pause to see the effect of interest rates moving higher and the effect that it has on the economy. More on the other side of the break with the panel.